You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that music means it is time once again for TWIFO, This Week in Futures Options, a program where we break down what the heck is going on the futures options side of the fence. That's going to run the gamut. Could be metals, could be ags, could be rates, could be some equities, could be some energy, could be live hogs. You never know what's going to make it onto the show every week. That's why you got to tune in. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-in-demand these days, Options Insider Radio Network. Glad you guys are getting a lot of value out of our content right now. These are times when people probably need a little bit of education, a little bit of understanding, need to be talked off the ledge a little bit. Maybe just something to listen to because everyone's stuck at home. Family's driving you crazy. Head on off to the side, listen to a podcast. We've got a podcast or two or a legion for that. 13 years worth of content there on the network for you guys to sink your teeth into and enjoy it. I'm glad to see many of you are doing just that. Unfortunately, of course, our studio is closed. Our buddy Sean Smith, the managing director of derivatives licensing, easy for me to say, over there at FTSE Russell, can't be here in person. I do believe he is making the trek cross country. Last time we spoke, he was isolated down there in scenic Florida. I think he's trekking across country to pick up his son at school. So unfortunately, won't be joining us here on the program today, but we will be joined a little bit later in the CME hot seat by Scott BAUER from Prosper Trading Academy. But before we get to Scott and all that fun, let's first break down what's been going on out here in this crazy topsy-turvy, mostly topsy week this week. Again, you guys can play along with the home game yourselves. CMEgroup.com/TWIFO. That's where you go to generate the reports, to follow along with the show, to do all the fun stuff. You say to yourself, you wake up at 3 a.m., you decide, what's going on in fluid milk out there? You can go to CMEgroup.com/TWIFO and find out for yourselves. You can play with the date ranges. You could run these scans like we're doing right now. Remember, this movers and shakers scan that we run is from our last show. So what's moved and what has been shaking since our last show last Thursday. So a full week, full 7 days from our last, not just this calendar week, which is where a lot of the TWIFO stuff comes in later on. So remember, a little bit frame of reference difference. But here, it's been a crazy, how the worm has turned. Oh, how the narrative has shifted. This chart the last couple of weeks has been just dominated by red. Remember I said last show we had to work to find 5. I think we could find 8 total names that were green last week across the broad spectrum of Globex products over there. This week, kind of the opposite. You gotta look really hard to find the red, and when you do, you find it mostly in the energy. Spoilers. Let's just go to the dark side first because it's pretty light. We've got number 5, lumber. So lumber not feeling pretty good, but it's still this week 1.3%. That's in the grand scheme of what we've seen of late out there in terms of sell-offs, listeners. That's pretty much nothing. So off 1.31% for lumber. Number 4, our old friend Class 3 milk. Dairy continuing to be volatile. This week moving to the downside, off 2.87%. Number 3, iron ore. These are all names that pop up on our radar a lot, yet aren't very exciting from an options perspective. So we don't get a chance to parse them that often, even though you guys ask about them. We have tried to parse them in the past. Iron ore, a great example of that. Not really an option story, even though it's off 3.7% this week. Number 2, good old RBOB, taken, I think the technical term is a shellacking, off 7.62%. And number 1 with a bullet to the dark side this week. You guys can probably guess, if you've seen the headlines, exactly where we're going to go with this. Yep, it's our old friend WTI, off 9.65%. from where it was this time last week on the show. So not a lot of love this week for all things crude oil. Let's move to the upside, the light side. If Sean were here, he'd be very excited because it's pretty much all the rest of the chart is light side. In fact, let's do it. Let's go top 10 because it's a rare treat to have this much light side to parse on the show lately. So let's get to number 10, the S&P 400, the mid cap. Up 11.22%. Number 9, feeder cattle. It's getting a little bit of cattle action out there. Up 11.52%. Gold. Good week for gold. Finally, of course, again, it's moving in lockstep with the market again. So perhaps not what you want from a hedge asset, a flight to quality, a fear-induced asset. Call it what you will. But still, c'est la vie, up 11.75% this week. Number 7, the Dow. The Dow E-mini flavor up 11.85%. Number 6, the old Nikkei, up 12.12%. Number 5, back to our old stomping grounds, the Russell 2000, up 12.67%. Just leading the market to the downside and now roaring back to life, leading the market to the upside. The Eurodollars, number 4, up 13.08%. Number 3, silver. Even though Uncle Mike on my other show, The Option Block, refuses to touch or adjust his 2-year silver collar. Silver, rocking and rolling, up almost 21.5% this week. Solid metals, the top 3 here. Number 2, platinum, up 23.18%. And number 1 with the bullet yet again. I guess those recent concerns have been mitigated because we're back up and up strong. Palladium, up 42.62%. Let that just percolate a little bit, listeners. As we keep on rolling into our first product category, it's dominating the tape. Everyone's talking about it. We got to start with energy, all things WTI. You know, it's been just a crazy time, you know, depending on how you look, whether you're looking at WTI, whether you look at our old friend OIV, which is, of course, the VIX of WTI, which is at 153 right now, listeners. So just to give you some frame of reference, usually we're talking about OIV, that crude VIX, the WTI VIX, in the 20s, maybe get into the 30s, getting into the 40s. Wow, things are getting pretty frothy. You might probably want to pay attention to what's going on out there. We're at 153 right now, and that's off the recent highs, listeners. So it's just crazy town out there from a vol perspective. You know, everyone's focused on the stimulus and on the equity space, and on a lot of products, that's been a big driver. And then we're going to talk about that, obviously, when we get to equities and others, but hasn't exactly resonated the way people hoped in the crude space. Of course, crude, particularly the shale producers here in the U.S., under tremendous pressure by this recent sell-off. Many would say they are the target of this price war between the Saudis and Russia. Russia, by the way, kind of admitting maybe they've gone too far, talking to Bloomberg, saying they kind of admit now they need to bolster the output, but they can't make an agreement. They're not gonna come to the table with OPEC, so we continue to plummet. Of course, Trump had talked up filling the reserves, which at these levels, probably not a bad idea, all things considered. And yet, when this big, massive stimulus bill came out, guess what? No money for that. They had talked about spending $3 billion to buy 77 million barrels to top up the Strategic Petroleum Reserve, and that would have, filled us up a little bit at least. And, of course, given a little bit of a floor, a near-term floor, to all things crude. Trump has also talked to OPEC and Russia to try to get them to halt this price war to help benefit U.S. shale producers. No dice, no love there. So the sell-off has continued. Coming into today, we're seeing a little bit of a lift. We're still at about 22.67 out there in WTI. Vol, as you might imagine, in the near term, has come off quite a bit. I'm looking at, like I said, the OIV is right around 150, which is, of course, kind of like that front month VIX calculation over there for WTI. That's off 73 handles. Again, that's a contract with a day to go. So let's not fixate on that quote-unquote vol. It's really just gamma at that point. Let's go out a couple of weeks. Let's go out to April. No, let's go to May. Let's go to May, actually, which has 22, almost 23 days left to go. The vol out there is about almost 132. So still pretty frothy, but that's off 56 handles from where it was this time, just from the start of the week here. So vol getting crushed out here in WTI, listeners, even though the underlying itself can't really catch a lift out here. Moving on to what we're seeing out here from an overall, let's see, 31% of the action out here was in this May contract. So May was clearly where the action was out here this week in WTI. Let's parse some of that now to see what exactly was lighting up people's tape. Like I said, we're at about a 22 out there in WTI right now. It was kind of looks like ever so slightly. The win actually goes out here to July. The July 12 half puts. Wow. We're talking about strikes, listeners, that a few weeks ago, let alone a couple of months ago, would have been absurd. And yet now we're seeing the 12 half puts in WTI in July just dominating the tape this week. 11,085 of those, 7,600 coming on Monday. And pretty much all of that opening, go figure, there's not a lot of OI on the 12 half strike. So someone opening for size on the 12 half puts, listeners, that's kind of just crazy town. Also worth noting that same day, 4,200 of the 20 puts traded as well, so maybe a bit of a roll. It doesn't exactly line up 1-to-1, but the possibility is there. 20 puts having done about 7,700, and that's a little bit more relevant strikes. The 20 strike, again, that's also crazy. We were just talking about the 40 strike not too long ago. Now we're talking here the 20 strike out here in WTI, doing 10,000 contracts this week in the May contract, and let's see, similar levels out here, 10,000 also as well in the June contract. So a lot of fun stuff. Before I get to all the skew and all that fun stuff, we are now joined in the CME Group hot seat by Mr. Scott Bauer, the president over there at Prosper Trading Academy. Scott, welcome back to the TWIFO program, sir.
I am glad to be here. How you guys doing? We're
doing well. We're just trying to make sense of all the madness that is unfolding. We're talking WTI right now really quickly before we go deep into crude. Just kind of catch us up. It's been a little bit since you've been on. Mad markets have pretty much resulted every day since you and I last chatted. What's been lighting up your tape? What's been the hot thing over there at Prosper since we last chatted, sir?
We haven't traded a lot. We've really chosen, as we always do, but in this period of time, quality over quantity. And so we've been very careful, both to the downside and on this upside rally here, what we've done. And we've been extremely, extremely successful in a short put selling type of position that I created. Not just selling a naked put, to lower your cost basis of a stock when it got hammered lower, but an actual almost like a put butterfly with an extra short put. And we have done that on probably 7 or 8 stocks so far and receive just incredibly massive amounts of premium because of the volatility that's out there right now. And we've hit it pretty big on every single one of them.
Yeah, that's interesting. That kind of reflects what we've been talking about in some of our other shows here on the network. These markets are crazy. These markets are wild. These markets are very wide right now, so it's difficult to get stuff off. But if you're savvy and you're deft, and it sounds like what you guys are trying to do over there at Prosper, you don't need to trade a lot of size. You don't need to swing for the fences to do well. You can keep it small, keep it nimble, and still fare fairly well in these markets. Would you agree with that, Scott?
100%. You have to. If someone is looking for that home run right now, not going to be back tomorrow to make that other trade. You cannot do that in these markets. You have to have the ability to kind of weed out all the minutia around you and say, all right, I'm going to put this position on for a certain reason. If I'm going to be, let's say, net a short put here, there's a reason I would want to buy a stock down here. There's a reason I want to do this. Or even if it's to the upside on, if you're going to fade this rally that we're seeing here, same sort of thing. It is not a time for heroes. It is not a time to, swing for the fences.
Would you say that equities have been pretty much your primary go-to, what everyone's flocking to you these days, or are there other products hitting the mix there?
No, it's really been equities. We have looked at a few ETFs as well, but really the premiums that we've seen on big cap stocks. We're not talking about any of the the high flyer stocks, but the premiums that we've seen across the board on big cap stocks like a Boeing, a UNH, a JP Morgan, for instance, that rarely ever trades with high volatility and high premiums. They've been really opportunistic and almost too good to pass up.
Hard to argue with that. Folks seem like they're still able to pass up everything out in WTI land right now, which is kind of where we were right when you joined us. I know last time you were on, you said you had a lot of interest out there in all things crude. Fortunately, the market doesn't seem to have any interest in upside. This is kind of the narrative we've seen week after week, and that continues to be the case. Let's check out some skew out here in WTI this week. Let's see if that narrative is continuing. Yeah, spoiler alert, it is, listeners. Out here in May, we're about 31% of the paper went up so far this week. Looking at the skew right now, the puts were leading the dance about 16%. Now they're leading the dance by a mere 15% rich to the at the money. The calls almost unched. They were 11.1% cheap this week. They're 11.3% cheap to at the money. So the calls kind of effectively unched, even though we have sold off a little bit. So that's interesting in and of itself. And the puts have come in a little bit out here. But we are somewhat in unprecedented times. We can't really seem to catch a bid and maintain it for much of any time out here. The vol getting annihilated, but still fairly frothy. Like I said, these contracts, like the May contract, it's still at 132 in the implied vol out there, listeners. So even though it's come off 56 handles over the last week, still very rich, very frothy out here. So a lot of interesting stuff. I know, like I said, you're focusing mostly on the equities. We're going to get to equities in a minute here, Scott, but I'm curious, have you been looking at what's going on out there in crude out there right now, either with WTI or with USO or some of your other names? And if so, what's been catching your eye or your clients' eyes out there?
So big time. Number one, let's go back a minute to a point you just made with WTI being down today, but volatility, calls really almost being unchanged, right? Because of volatility. So what a lot of people, a lot of even professional traders, when I say professional, I'm talking even ex-floor traders, what they don't understand is you buy a call and a stock goes up, you expect to make money. You buy a put, stock goes down, you expect to make money. Vice versa. That's not necessarily true when you get into the massive kind of range of volatility, implied volatility that we're trading right now. So you can get an instance like this today where we see crude absolutely getting crushed again and calls almost unchanged. And that's because of volatility. So what I have been doing, not just in the crude space, but with the equity trading as well, is leaning things from a volatility perspective to the short side, but at a minimum, creating spreads, creating opportunities that don't get me long volatility. So I want to be at least neutral it right now because, listen, premiums are expensive. However, that can change, just overnight. Just because they're really expensive doesn't mean that they can't get more expensive. More than likely, over time, they are going to come down.
Let's fast forward to equities now because all people have equities on the brain right now. We're seeing just these massive moves as a result of of all the mad stimulus, let's just break down a little bit, set the table, listeners, for where we are right now. Coming into showtime, it seemed like for a while there we really couldn't catch a bid and maintain it in the broad equity markets. Finally did it this week, had the first multiple session up close since February 12th, pretty much out there. So it's been a while since we've seen a sustained rally out here. In fact, we asked you guys about what you think about this. Is it a dead cat bounce or not? You guys have a lot of opinions on this. We'll get to that a little bit later in your feedback segment. But we saw a big rally earlier this week. S&P closing up, or people like our neighbor across the street here, Boeing, feeling the love. Of course, all this driven by this massive stimulus. Massive is undersells it, really. It just dwarfs anything. Even the New Deal, by inflation adjusted, is about $800 billion. They're talking $2 trillion here. So it's a massive cash injection to individuals and to the economy over here in the market, liking what it's seeing. So I'm curious for you, Scott. I'm going to put the question to you that I put to our audience and to many of our co-hosts throughout the week as well. We've seen a sustained rally for the last few sessions. Coming into today's session, it seems like we're going to be 3 for 3 here now with yet another rally. The rally is actually exacerbating as we're talking. We're closing in on up 5% now in the S&P. I'm curious, are you, and indeed perhaps more importantly, are your clients, are they buying this rally, or do you think this is kind of the mother of all dead cat bounces here, sir?
Without trying to burst anyone's bubble here, I am cautiously pessimistic. Okay, long run, love the market. If you want to invest in the market, great, and you're not going to look at it for a year, 3 years, great. This rally here, just as I felt on the downside, was too much, too fast. I think this is too much, too fast on the upside here. There's really no fundamentals right now of the market that sustain what we've seen this much of a snapback here. Okay, I would love to see the market consolidate. I think most professionals would. Consolidate means, okay, let's see the market trade in 2 to 3% ranges per day, not 5 to 6% ranges. If we would have said that months ago, we want to see the market trade in 2 to 3% ranges, you would say you're crazy, right? But now that's what we need to actually get a base. And I'm not saying that what we had last week, where we bottomed out last week, I don't know that we're going to touch that again. I don't think we are, actually. I do think that we will see some drawdowns from where we are right now.
I'm curious, Scott. I'm kind of taking the pulse of a lot of our contributors here on the network. We are in completely historic times right now from an overall options perspective. We've seen the entire U.S. equity option market go fully electronic. CME, of course, shuttered their trading floors very early in this. So even historic legacy products like the Eurodollars, which have a long presence on the floor, are now 100% electronic. We're seeing some issues and some concerns about that as a result. Are you encountering any issues from a liquidity perspective as you're out there trying to get stuff done? Obviously, things are going to be wide. We know that. Vol is high. The markets are moving. We're all kind of collectively in a fast market. But now we have added on top of this unprecedented level of everything being 100% electronic for the first time. Have you encountered any issues with this as a result?
So the issues that traders or investors that want to get into those products will see are in the types of trades, the type of spreads that are not the norm. So a normal spread is one leg buy, one leg sell. That is done easily electronically. It's the multiple leg spreads or the more complex strategies that really does need to, or in the past had to, go to the trading floor to get filled. And you can't do those electronically. Now, maybe over time that's going to change. But for right now, that's a very, very big issue for liquidity providers. That's a very big issue for some of the big funds that are trading in the euros or anything else. Even if you talk about the CBOE, SPX, or even in the VIX product, trading on the floor here. So that is a very, very big issue.
Yeah, legacy products, SPX, Eurodollars, now 100% electronic. Thankfully, we haven't seen too many headline-making disasters outside of Ronin, obviously a very storied name in the market-making space, getting liquidated last week. Thankfully, we haven't seen too many other repeats of that, which I think a lot of people were concerned about. I think this recent rally in the market kind of getting a little bit of a release valve out of there. If it had continued to sell off for a few more sessions, we might maybe have seen more of those as a result of just the continued one-way risk that was going on. A little bit of a rally here. taking a little bit of the pressure off, metaphorically and actually out here. Let's look and see what's going on out here in the old S&P, the old E-mini S&P right now. Right now, like I said, for the week, we're actually in the front contract is looking pretty good, as you might imagine. All of them looking pretty good, up about 300 handles, or up nearly 13% so far on the week. Just say that out loud, 13% for the week in the S&P. These are the times we live in now, listeners here. If you're wondering what the hot thing is right now, we're at about a 25.85. So we were talking about whether the 2400 level is real. We're now almost 200 handles past that, just a few sessions later. And the hot strike out here right now, the hot option, are the 2800 calls. 23,000 of those going up here this week. Actually, no, I take that back. If we dig a little bit farther back, it was actually a little bit more reasonable comparatively. 2,700 calls, doing 34,000. These are going up out here in September. So a little bit longer term, a little bit farther out of the money, maybe reflecting a little bit longer term optimism. They went up 17, almost 18,000 on Monday, 12,000 on Tuesday. The lion's share of that opening. So some opening 2,700 paper out there, which is kind of interesting. Followed hot on its heels by about 27,000 of the 2,500s, also in September. So maybe some verticals going up out there as well. But either way, upside in September, kind of the order of the day, which is perhaps a little bit surprising. Coming into showtime here, we have seen the VIX at about a 60 right now, which puts it down 16 handles from where it was this time last week. Listeners, the VVIX, a.k.a. the volatility of volatility, right around a 167. Coming into showtime, that puts it down about 10 points from where it was last week. And the RVX, a.k.a. the VIX of the Russell 2000, at about a 65. So that spread, that VIX RVX spread, which was almost non-existent last couple of weeks, they were pretty much moving at lockstep, now has widened out a wee bit up to about 5 points, which is somewhat interesting out there. You know, we talk a lot about small cap here on the show. Scott, I'm curious if that's an area that you're interested in or your clients. And then B, it certainly seems like a lot of people are starting to gravitate towards that because for a variety of reasons, some of which are still confusing to people, small caps have led the market down in the sell-off and now are leading the market up in the rally. Does that surprise you, A? And then B, are you seeing maybe any growing interest in small caps out there from your clients as a result of these extreme swings?
So it doesn't surprise me because you typically see a more volatile reaction one way or the other in the small caps, regardless of which side it's moving to. So it does not surprise me. Overall, some of those stocks are a bit easier for people to trade, so that may lend itself to some of the volatility in there as well. Going back, if you don't mind, you were just mentioning about some of the volume, some of the option volume today out there. And I want to point something out that traded yesterday, actually, and I'm looking at here. These are week 3, because you were talking about a lot of call buying going out to September. These are week 3, May 3350 calls. Okay, the 3350 calls traded almost 8,000 of those yesterday. So, pretty big volume on something like that. I just want to point that out for some of your listeners. And one other thing, if you don't mind me pointing out also, on any given day, historical average here, we see about 63 to 65% of the total option volume that trades CME E-mini options being on the put side. Yesterday was the first time in my recent memory, and I have not looked every single day, first time in my recent memory that I saw more calls put than trading than puts. It was 52 to 48 calls to puts yesterday.
That just shows the kind of rarefied air that we're in. 3,300s in the week 3s. That's an impressive move. That's there could be overriding on those strikes, obviously, but still, if there is any, got to be some buying on some levels out there. That notion that's well beyond the levels. That's an aggressive move in a couple of weeks. That shows people are, in this case, perhaps quite literally buying this, not a dead cat bounce, but it's something real, which is kind of coming in spite of the fact, of course, you saw the stimulus earlier this week, but now this morning, everyone's waiting for this jobless claims numbers, and it was pretty much worse than people were thinking. They were estimating 1.5 million claims, all those quote-unquote economists out there. They call it dismal science for a reason. They were only expecting 1.5 million claims because they got about 3.3. They got over double that. It's pretty much the worst we've seen pretty much ever out there. Scott, were you surprised that we managed to maintain. In fact, the rally is exacerbating as we speak in spite of these kind of apocalyptic numbers we're seeing on the jobs front, sir?
Honestly, it makes no sense to me. The only thing that that I can make any sense of that at all is that the whisper number out there, for whatever that whisper number was something over the 3.3 million that we got. But still, this 3.3 million number to me is just the tip of the iceberg. So there has to be something more to it. It baffles me why we rallied on that number. Going into that, if you looked at futures overnight last night, we were down 3% or so. I saw Dow futures down 500 at one point. S&P futures were down, I think 60 points. And then we get this just, like you said, apocalyptic number, and we rally. That's kind of a sign of the times right now of how trade is in the markets. There really is not a lot of rhyme or reason, and I don't care what expert you talk to or the economist like you just mentioned, nobody really knows. So for people, you're getting a lot of Monday morning quarterbacks right now. Oh, I knew it. I knew we hit that bottom. I knew I should have bought it there. I knew I hit, it's just we're all going through these times that we've never experienced before, and I've traded live on the floor through just about every apocalyptic event that you can think of. This one blows them all away.
Yeah, and I'm hard-pressed to think, and I walked on the floor of the SIBO in 97. We had certainly some shocks to that time. We had, of course, 9/11. We had even some things in the go-go 90s. People think it was all up, but there were some interesting shocks going on there. Yeltsin seemed like he was going to be, quote-unquote, assassinated, or he had died just about every other week out there. Surprise Treasury secretaries leaving, all that kind of fun stuff. And yet, you're right, nothing really can compare to what we're seeing. Even 2008, some of the depths of 2008 from a historic perspective. We're kind of blowing all this out of the water with moves that are kind of head-scratching. I was like you. I thought we'd be off today given these numbers, and yet we're just rallying. Or if we did rally, it would mitigate once these numbers came out, and yet it's kind of the opposite. The numbers are just extending the rally, if that makes any sense out here. Since we're talking about apocalyptic jobless claims numbers, we got to talk to gold then. Gold, like I mentioned here, coming in from last show, gold was on the upside, number 8, up 11.75% from our last show last week. So it's been a good run for gold. For all these people out there who've been kind of hand-wringing, oh, my gold, I bought it for a hedge, and now it's been moving in lockstep. It's moving in lockstep again, though, for reasons that might make a little bit more sense. Market's rallying and gold's rallying, but maybe the market end of that is the one that doesn't make sense, like Scott said, because on apocalyptic numbers like this, gold should rally, and the market should probably sell off. So in this case, the equities are the ones being the weird one as opposed to gold. Gold's doing what you expect in a time like this. You got record-breaking unemployment. Gold's going to be getting a little bit of a lift at 1660 right now. It puts it up 170 handles just for this week, up 11.33% right now here since the start of the session this week. We've seen some interesting things out there as a result of all this. Of course, there's been some concerns about physical access to physical supply in these markets. You want to get to your warehouse where your bullion is stored and actually ship it. That's an issue right now. People are not going to work. People can't get these things. So that's seen some bid-offer spreads kind of get a little wacky out there as a result of having a little bit less access to the physical than you probably would like in a commodity like gold right now. Of course, also have seen the record numbers. And that's not enough. CME mixing it up here this week, deciding to, perhaps as a result of some of these disruptions we've seen out there, or maybe just trying to get more people able to get access to this gold contract, deciding that they're going to mix it up, get a little bit smaller, a little bit more bite-sized contract out there with a new 100 troy ounce, 400 troy ounce, and 1 kilo gold contracts on those size contracts with those gold bars. So those are, of course, not live yet. They're still pending approval, but they're expected to launch, hopefully, if all goes well, by the first week of April. So again, that's a little bit smaller delivery size, helping to make this contract probably a little bit more accessible to a wide array of people, which, gold's making a lot of headlines these days. People want to play it. They want to trade it. And so having a little bit more access out there, not the worst thing. Like we said, we're at about a 1660 right now. The lion's share of the paper this week coming 37% or so in the the May contract. And the big print out here this week, I said we're at about a 1656 or 57 or so right now. It was actually the 1700s, and not in April, but actually, or in May, I should say, but in June, the June 1700s doing 7,207 this week. Let's see how that breaks up. The lion's share was actually on Monday, 3,500, so about half of it on Monday, 2,000 on Tuesday, kind of light yesterday, only 200 yesterday, kind of quiet, and 1,500 more today, so it's biased towards the opening. So opening 1700s, again, not surprising. We're racing towards that strikeout there. Then number 2, going back out to the most active month out here, back to May. The May 1575s now pretty much in the money calls here, so probably blowing through that strike. Looks like a lot of closing paper, and that's pretty much what it was. So blowing through that 1575 strike, folks coming in, take those off, about 5,500 of those. Scott, we haven't had you on since gold really started doing its kind of, shall we say, its weird dance over the last couple of weeks. You know, I joke all the time on this network, we're kind of only half joking, half truth, that when it all hits the fan, correlation goes to 1, which is why you can only really rely on volatility and a nice put as your the 2 reliable hedges. Everything else, when it all hits the fan, they all tend to go to 1. Gold very much reinforcing that over the last couple of weeks. What are your thoughts on what we've seen out there in gold of late? The fact that it hasn't really been too reliable of a hedge as of late. And also, what are you hearing from your clients and your mentees out there in terms of the metals these days?
So number one, like you said, it's been a quizzical trade, let's say, over the last few weeks when the market was, almost at its bottom and getting, sold off and just so much pressure. We actually saw gold sell off as well. And really the reason behind that was at the time is people were liquidating positions in gold, which typically is like we all know, it's that the risk off you go into gold, but people were liquidating their gold positions to meet margin requirements and to pay for other things. So that's why we saw that dip down when the market really took a nosedive last week, and that has obviously gone away now. And now you're seeing the opposite. Like you just said, we're seeing huge rally back in the equity space here, which would typically be a risk on sentiment and be negative for gold or bearish for gold, and we're seeing gold jump. What I think you just said, it's up 12% over the last week now, 1660 right now. So, at the end of the day, yes, it is that safe haven hedge, but what happens in the middle, like we've seen over the last couple weeks or so, is not indicative of the end game like you were talking about.
So, Scott, I'm going to get some listeners on the show because obviously there's a lot of questions out there right now. But before we do, we have time for probably one more product category. Anything lighting up your tape right now you want to really take a deep dive in before we get to some of the listener questions? I'll let you have pride of place for this last choice, sir.
The big banks to me in the equity space, I've really been keying in on a Goldman Sachs, on a JP Morgan. And I know Goldman got upgraded this morning, but being a former Goldman trader and just, kind of knowing the big bank space of the trading banks. So again, we're talking about Goldman, JP Morgan, maybe a Morgan Stanley. In this environment, they will make more money than they have in the last 10 years. Now, a lot of that may be offset. They may lose a lot from the financing side of things because interest rates are so low. But trading revenues for these big banks are going to be massive, and I have stayed very bullish these big banks through this massive decline in rates, and especially over the last couple weeks where you can get these things. I mean, Goldman traded down to 120, JP into the low 80s. I'm not sure it ever broke into the 70 handle. Man, oh man, we're going to see some, in my opinion, blowout numbers from the banks next quarter.
Well, Scott, we have to keep on rolling, but before we go, if folks are intrigued, they want to learn more about what you guys are doing, maybe they want to reach out to you with some questions, where should they go? What should they do, sir?
Perfect. So you can reach me personally. I'm always available. My email address is scott@prospertrading.com, or you can just go to our website, prospertrading.com, or you can find us on Facebook and anything out there as well. But we are a very, very hands-on educational company guiding our clients, guiding all of our students bell to bell during the day through the markets.
There you go, prospertrading.com, the place to go to check out Scott and his crew. We're going to check out some ags right now as well. We haven't had a chance to really do that too much because, quite frankly, ags haven't been lighting it up in all of this turmoil. It's been mostly equities and metals and energy and rates and a few others. And so ags have kind of been the forgotten stepchild out there. And that's still pretty much the case if you look at the top 10 over the course of the week. But over the last few hours, last session or so, as a result of this stimulus, we have seen some little bit of boosts out there in beans and in the grain. As you know, the stimulus, people are thinking maybe this might give a little bit of a lift to soybeans, some of the other ag products out there right now. So let's pull up the soybeans really quickly, see what's cooking. I know there's a lot of ag junkies out there, and they've probably been waiting patiently. And some of you not so patiently writing in, saying let's get a little bit more ags on. So we're doing that right now. Soybeans at about an 879 out there right now, which is up about nearly 2% for the week. So kind of bucking the trend out here. Looking pretty good from the start of the week here as getting a little bit of a lift from this stimulus. Vol coming off pretty much across the board, but not a ton. Nothing like what we saw in CRUDE. We were talking 50 handles. We're talking about 3, 4, 5 handles out here across the board. The most active contract out here in the beans, going to go back out to May. In particular, they did about 37% of the paper this week, and it was the 900 calls. So not surprisingly, closing in on that 900 strike, about 20 handles away. 900 calls going to be leading the action, doing about almost 7,000, which is a decent clip for the beans out there. 3,300 is about half of that on Monday, 2,000 on Tuesday, about 1,000 so far on yesterday, and kind of light today, only 500 today. And decent chunk of that opening, but not all, so a little bit of back and forth, which you would expect given the fact that we're encroaching on that strike. Folks are going to come in, they're going to open, they're going to close, they're going to trade back and forth out there. Also seeing some action here on the 880s, which are pretty much at the monies, doing about 5,700. And on the put side, the 800 puts, about 6,000, almost 6,100 there. So those are actually the number 2 contract out there. The 800 puts doing 3,800 yesterday. And then the rest kind of scattered throughout the week. Let's go a little bit farther out to see if we see any funky prints out there. Yeah, going farther out, 900 calls also active out here in March of 2021. So interesting. If upside is your game, then some folks playing a little bit of the long game out here as well. And 1020s also active out here in September to the tune of about 1,500 of the 1020s. And you know what? I think we have to keep on rolling into your questions. I want to make sure you guys get on the show as well. So without further ado, let's head on into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, welcome to the Futures Options Feedback. Speaking of your feedback, some of you are saying you're having some issues with the live stream. That might be an issue on Mixlr's end here. Obviously, everyone's using the internet these days, so some of these online services having some issues. So hopefully that's not the case. It seems like it's working on our end. It might be on an end user end, or it could be just the Mixlr having intermittent outages. If that's the case, of course, the podcast will be available shortly after the show. Nice and edited and cut together. You can enjoy that at your leisure out there. All right, and let's talk about what you guys have on your brain as well as what we have in store for you guys. Let's kick it off here. We asked you guys, this is surprising, you know, the worm hasn't really turned that much on your voting. We asked you not that long ago, you know, we just blew through 2,400 not too long ago in the S&P. We're up 9% that day. Are you guys feeling this? Were you feeling this is a real rally, or this is a bit of a mother of all dead cat bounces, where you're going to close the end of the week north of 2,400, which would be real, at least for this week, or you're going to close south of 2,400, which is a dead cat bounce? Overwhelming majority of you were fading this, and still are, 73.4% now with a few hours left to go in this 73.4% of you saying it's a dead cat bounce. So we're going to close this week south of 2,400, which would at this point be a nearly 200-point sell-off that we would have to accomplish in the S&P to make that happen. Again, not the craziest thing we've seen, but that would be a pretty aggressive sell-off. And then this is real, so we're going to close north of 2,400. That's about 17.5%. And the cash bunch out there, those of you saying, I don't care, I'm in cash, you're at about 9% right now. So the fade is in, and yet that doesn't seem to be stopping the market, and it doesn't seem to be changing your voting. You're still continuing to vote as the hours tick by here that this is a fade, even though your comments are leaning other ways too. Again, I like this handle here, Sasquatch Blood, saying, I'll venture to say this is the mother of all dead cats. Well, you and apparently a lot of others out there, and yet the market not agreeing with you. Late stage capitalism, another good handle out there. He says, guaranteed dead cat bounce. We still haven't prevented the spread of the virus in the U.S. Yeah, I think a lot of people could see an argument for that, and yet the market laughing it off. Lyndon chiming in says, end the poll now, dead cat bounce just won. We can't do that because there's more time to go, A, and B, the market is just mocking all of us, all of you at least out there who are voting for this and saying, no, the dead cat bounce is not in, this is real, at least for this week, because we're almost a couple of hundred handles away from that 2,400 level. We'll see. It all can change. The worm can turn in a heartbeat, but right now it seems like this upside is here to stay for the rest of the session. We're still up north of 4, about 4.25%, so not quite as high as we were at the tops, but still feeling frothy out there. Let's see. Brandon wants to know, a lot of you have this similar question, is this vol collapse for real? That's the $1 million question right now. As you said, coming into Showtime, the VIX cash is at about a 60, off about 16 points. It's hard to say a VIX of 60 is a collapse, but from where it closed north of 80 a week ago, that is a bit of a collapse. You're seeing products like VXX, which play that fade, dropping quite a bit as well. We talked about the VIX futures, how they're lining up, and how other volatility products have been lining up, perhaps exacerbating some of this out there as well. Brandon, I have a hard time saying, we're at about a VIX of a 60 right now. I know people are starting to load up on some of these shorter vol trades out here. Given the fact what we're seeing in the broad rest of the country, how this escalating cases in large markets, this is not central rural Iowa. This is New York City and New Orleans and other areas where there people actually live that are having massive spiraling cases of this outbreak. It's kind of hard to see the economy returning to normal in these areas anytime soon, and who knows? We just had a very bad milestone here in the U.S. today, of course, spiking over 1,000 deaths. So no one wants to see milestones like that. So I have a hard time, and again, we'll talk about this more on vol views tomorrow. I have a hard time prognosticating for a lot of aggressively lower vol here in the very near term. I think there will be things that will keep us, if not spiking, at the very least around these levels. I don't see us getting much below. The S&P is clearly moving. We're moving another 4% today. So that equates to vol actually probably a little bit higher than where it is right now. So we're meriting this level of vol right now. We're moving enough to sustain it. If that stops, if the S&P is just sitting here for days on end, moving 0.25%, then the math at the end of the day is going to be inescapable. Vol will have to come in. But I don't foresee that scenario happening. As a result, I don't foresee vol coming in. So is this vol collapse for real? I'm going to have to say what you've gotten right now might be the extent of it for a little while. If you're fading it, hey, more power to you. I certainly hope you are right. I certainly hope we continue to see a turnaround in the virus cases, the economy getting back to normal. I think we all could use a dose of that. So I certainly hope that it is for real. I'm just not feeling that out there right now, bro. Sorry to be the bearer of bad news out there. If you want more bad news, by all means, check out our Advisors Option Show. Just recorded it yesterday. Pretty dire outlook on that one. So stay tuned for that, listeners. Tolland wants to know, can I get access to the TWIFO reports outside of the live show stream? Thanks, and keep up the good work. Yes, I said at the top of the show, I say it every week. These reports that we generate, that we use throughout the show, they're not just live during the TWIFO program. So not just every Thursday at 1:30 to 2:30. Nope, they're live throughout the week. You can go there on Sunday night and say, I want to check out what's going on in fluid milk. You can do that. I want to go check out what's going on in gold. Whatever product it is, floats your boat. CMEgroup.com/TWIFO is the place to go. And if you like those, you can always upgrade to the full kit and caboodle over there in Bantix land. This is easier for me to say. N9IP. It's a great handle. N9IP wants to know, or just says, great show. Love all the analysis. Wish it was longer or every day. Well, thank you for that love. Yeah, we have similar sentiments from other folks. They would love a TWIFO. They love a daily TWIFO. So D-TWIFO, I suppose. That's these markets could merit it. And yet we just don't have the time to make it happen, unfortunately. We have other shows to do, other things to do. I guess if we can get folks behind it to do it every day, maybe we could. The audience is clearly there. It's just everyone's got to put the show together behind it. But yeah, we love it. We're trying to get more content out to you. You guys are clearly devouring everything put out to the network right now. So a lot of stuff is hitting the network as we speak. So if you can't get it live, get it after the fact on the full network. It's all there, nicely edited podcast version. Stuff going back 13 plus years, listeners. So you got a lot to sink your teeth into out there. We got Bud Fox chiming in on SPY 250 puts, huge put volume. Thoughts, buying or selling? Well, we're talking mostly the S&P here, mostly S&P futures options here, so we haven't talking SPY a lot right here. I like the handle, though, Bud Fox. That's that's great. Obviously, anyone who's familiar with Wall Street knows that's Charlie Sheen's character. But tell you what, since I'm looking right now at the report, let's go back to equities really quickly, see if we can do a little live analysis to see if we're seeing similar paper out here in the E-mini options, because that would kind of confirm that the 2,500 put strike is the strike du jour. You don't say, he says March. Okay, March. Let's go out to March and see if we could see something similar. Yeah, that's going away pretty soon. 2,600s in that contract are the trade du jour this week. Mr. Bud Fox with about almost 16,000 going up. On the put side, you got to go pretty far down to get the 2,500 puts. Let's see, 1, 2, 3, 4, 5, 6, 7. They're the seventh place put in that month, so pretty far. Only 4,700 total for the week. The top trade was 9,500. But that said, of today's activity, they are tied for first. 3,500 or so today versus 3,500 of the 2,300 puts going up today as well. Oh, actually, I take it back. First would be 2,400 puts with about 4,200. So, yes, there are 2,500 puts trading today in the E-mini here as well. I have to imagine there's a lot of back and forth on both of those. Look at just all the shows we've done lately, the diversity of opinions we have on whether this is real or whether this is a dead cat bounce. Some folks, like Scott and others, looking to fade here and harvest some premium. Others looking to take some nibbles. So I think there's a lot of back and forth on that 2,500 strike. We are at 2,574. It isn't that far out of the money of a put. It's a long way to go with 1 day to go, I'll give you that. But it isn't that insane that we might see some back and forth action out there. Again, if our audience is to be believed, we're going to be shy of that strike by tomorrow's close. So in that case, might want to load up. Let's see. This last one here from Lou. He wants to know why Rutt isn't leading the charge to the downside again this week. I think this came in last week, so he's a little late on this one. This is one for Sean. If Sean was here, I'd have him chime on this one because this is obviously his bailiwick. I will say this, though, Lou. You should be happy that Rutt is leading the charge to the upside here on the equities this week. So no matter what's happening given week, if it's upside or downside, Rutt is, and all the flavors of Russell 2000 are leading the charge to the upside and to the downside. So it kind of puts the lie to the old saw that small caps are not really impacted by these macro trends, even though it's not really macro anymore. It's very much a domestic, and indeed focusing on micro, smaller names are getting impacted now as well. So it is not just the broad global macro trend we're talking about anymore. It's kind of day-to-day life. So in that sense, maybe small caps and large caps, not that far apart, but they are leading the charge this week, just not in the direction you were talking about there, Mr. Lou. All right, unfortunately, that music means we've come to the end of our epic sojourn. You guys want more? There's more hitting the network for you, so don't worry. We got you covered. Hopefully you had access via the Mixler. If that wasn't working, let us know. We'll reach out to them. We don't produce Mixler, unfortunately, so we can't control their technical issues. We can try to see what's going on. And, of course, the podcast always available after the live stream on the network. You know where to get it. Just subscribe to the full kit and caboodle over there, the Options Insider Radio Network. I'm wherever you get your finer podcasts, iTunes, Google Podcasts, Spotify. We don't judge. It's available on all of them. Or if you want the easiest access, just grab our app. It's It's available for all the major platforms, iOS, Android. You guys can check out not just the new stuff, but go deep into the archives. It's all there. 13 years. I guarantee you will not want for content. Check out that app. Check it out. And on behalf of my guest, Mr. Scott, and of course our buddy Sean, who's hopefully staying safe as he's traveling cross country, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many great questions, for voting in our polls, for listening live, for all the fun stuff that you do. Keep it coming. We'll be back again tomorrow live, 1 p.m. Central, 2 p.m. Eastern for Vol Views. Then kick it all off again on Monday with the option block and all the other good stuff. And then we're back again on Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.